My name is Darius Dell. I'm the founder and CEO of 42 Macro. What we do at 42 Macro is we specialize in quantitative, systematic approaches and helping investors across the buy side, across corporate treasury offices and high net worth individuals sort of risk manage their portfolios with a kind of a real systematic, deep understanding of what's happening in the macro economy. Prior to starting Hedgeye 2.5 years ago, I spent the 12 years, dozen years at a firm called Hedgeye Risk Management, where I was the head of macro for their team there. And then prior to Hedgeye, I was at finishing up my studies at Yale. So in terms of kind of where we are today and where we might be headed, I think it may be great to start with kind of a look into what we call our weather model. That's our primary tool that we use to help investors kind of understand where we are in all the key macro cycles that matter. And so, if you think about macro, you can sort of boil down macro to about 8 to 10 principal components. And we'll start with the real economy cycles here on the left side of this chart here, where we have growth. Growth is trending lower. It's expected to continue trending lower when you look at the deltas between the current GDP and next 12-month estimates as derived by Bloomberg. If you look at inflation, inflation's been trending lower. It's expected to continue trending lower over the next 12 months. Employment, the unemployment rate is trending lower. It's expected to trend higher over the next 12 months. Corporate profits, if you look at the implied sales growth rate for the S&P, that number's been trending lower. If you look at the implied earnings growth rate for the S&P over the next 12 months, that number's been trending lower as well. Fiscal policy, our budget balance as a percentage of GDP has been trending lower. In fact, at minus 8%, this is the record non-war, non-recession U.S. budget deficit. And so that's got some implications for markets as we progress into the second half of the year, which we can unpack. On an effective exchange rate basis, we're trending lower as well as due to all this fiscal largesse. So that's the real economy cycle. That's kind of where we are from a real economy standpoint. When you look at the financial economy cycles, which are equally as important in our opinion, we have monetary policy as a proxy. And so we have a few liquidity tools that we use to help investors stay abreast of liquidity developments. We have our adjusted net liquidity model that's been trending lower. Our global liquidity proxy has been trending lower as well. Domestic broad money supply and global PPP weighted broad money supply is trending lower from a liquidity standpoint. When you look at interest rates, the benchmark policy rate's obviously trending higher. If you look at the 2-year nominal yield spread relative to that benchmark policy rate, that number is trending lower, albeit it's up significantly from kind of a trough of around minus 150 basis points as recently as a couple of months ago. And then when we look at positioning, which is a very important financial market cycle to monitor, we aggregate US dollar positioning across all the major currencies. That number is 15% on a non-commercial net length basis as a percent of total open interest. That's a neutral signal relative to the trailing 3-year sample. We aggregate US rates positioning across the curve as well. That's an extreme bearish positioning right now at minus 13% non-commercial net length as a percent of open interest. And then we aggregate commodities and equities to identify greed and turning points in market cycles. Commodities in extreme bearish positioning, and the US equities is an is a neutral position right there. And so in terms of what that's all signaling from the perspective of asset markets, we are currently in what we call a deflation regime. And what deflation ultimately means is that the economy is both the economy and markets are saying growth is trending lower and inflation is trending lower. And that has a whole sort of set of, kind of implications as it relates to forecasting and anticipating dispersion across asset markets. Right now, the current setup from the weather model is saying the stock market signal over the next 3 months is neutral. So you would not expect positive or negative excess returns in this particular market. The bond market signal over the next 3 months is neutral as well. You would not expect positive or negative excess returns. US dollar signals bearish, so you should expect negative excess returns in the dollar. Commodities is bearish as well. And digital assets, we proxy digital assets for Bitcoin as well. We do have some crypto hedge fund clients as well. So in terms of who we serve, we serve all the who's of the asset management space. We have a number of large corporate clients as well. We service our investment advisories and high net worth individuals all across the world. We have about a few thousand clients after a couple of 2.5 years of operation. So I'll kind of give you guys a quick abridged version of this presentation. I know we don't have too much time. We publish this presentation at the beginning of every month. It's called our macro scouting report.
Darius, just to be clear, Darius, you have 20 more minutes. So
yeah, I know. Yeah,
we have 30 minutes. Yeah.
Oh, gotcha. Yeah, absolutely. I'm going to fly through each of the segments. So what we do in this presentation.
Just Darius, can we slow down here and go back to your original screen with this signals?
Yeah, for sure. Absolutely.
Because what's more important is that we make the big points, then we go through every point.
Yeah.
So you've got a lot of negative signals.
Yeah, yeah. Well, negative doesn't mean bad for markets, right? And so negative, something like a falling unemployment rate is actually a positive signal for asset markets if you sort of look at the back test on the excess return dispersion associated with that signal. So it's usually positive.
And you said that there's a deflationary trend. Where's the deflation coming from? Is that from energy prices going down?
Oh, it's for a variety of reasons. We're actually having a significant. So this is a loaded question you asked, but I think it's a very important question to answer, which is we're having a significant amount of disinflation that's very broad based. It's not just energy and food. Obviously, we have a significant amount of energy and food disinflation. We're currently tracking at 1.0% on a 3-month annualized basis in food, minus 26% on a 3-month annualized basis in energy. But it's not just energy and food. And when you look at median CPI, the last 3 months of median CPI have seen it basically fall from around 7.5 to around 4.5% on a trailing 3-month annualized basis. That's new and unusual, and we'll unpack why that's new and unusual in subsequent slides. But we're also seeing a significant decline in trim mean CPI as well. Trim mean CPI. So median CPI is obviously it implies the median of the change in the CPI basket, which has about 400 different price measures. And the trim mean, it's the same measure, but we're lopping off the top 8 and then bottom 8 percentile of the sample. And we see significant disinflation in recent months here as well, going from about 6% 3-month annualized to 3.1% in the month of May. So it's not just food and energy in terms of this inflation we're having. Ultimately, we don't believe we're going to continue to see these kind of positive inflation outcomes on the disinflation front once we get past the June data. Once we get into the second half of the year, it's very likely that inflation firms on a relative basis relative to consensus expectations, because consensus is expecting a recession to commence in Q3, which we disagree with, and then certainly potentially on an absolute basis as well as the base effects start to kind of recede in the second half of the year. So yep. So going back to the beginning of the presentation, so I'll sort of give you guys the highlights from each of the main segments of this presentation. So what we try to do for our clients at the beginning of every month is create the full distribution of probable macroeconomic outcomes and try to opine on whether or not we see one particular scenario as higher probability than the others. Sometimes the distribution is reasonably flat based on all the data that we're tracking, and we have a myriad of models and sort of procedures that we use to kind of understand where we are in all those cycles that we highlighted at the beginning of the presentation. So I'll start with our modal outcomes presentation, which ultimately is designed to sort of help investors understand that the U.S. economy was likely to be resilient and remain resilient. This is something we've been very divergent from consensus on since going back to August of last year, when we adopted the view that the U.S. economy had resiliency and juice and was likely not to head into recession anytime soon. Once the yield curve inverted in the fall of last year, we had a view that, hey, based on historical patterns and relationships between the yield curve and the business cycle, the highest probability outcome of a recession commencing was Q4 of 2023. The second highest probability outcome is Q1 of 2024. And so we've understood that the entire time since going back to the fall of last year, and that's really helped our clients not get too caught out over their ski tips on the bear side. I know it's very in vogue and very popular to be bearish, but the reality is being bearish hasn't gotten anybody paid this year, because ultimately the bear case has been wrong, which is the recession just hasn't shown up yet. And it's unlikely to show up until we get to Q4 or Q1 based on our models. And so why hasn't the recession shown up? So I'll start with, there's sort of 5 main reasons why we identified that the U.S. economy had resiliency, and most of those reasons are still persistent today. And so the first reason is we have record cash on household balance sheets. What I'm tracking is checkable deposits in currency on household balance sheets at $5 trillion. That number's up from around $1 trillion prior to the pandemic. And so when you hear this sort of what I call kind of macro touristy, lazy macro thrown about like, oh, excess savings are declining, this and that, the reality is that's just incongruent with actual data. We're at a ratio of total assets. We're about 3% of total assets in cash for the household balance sheet. You got to go way back to the mid 1960s to see a ratio this high in terms of how consumers might feel about their balance sheet. We have near record cash on corporate balance sheets as well. We're about $1.5 trillion. That number's down from the peak that we got post all the PPP lending that we did in the pandemic, but it's still very much a record high when you exclude that from the sample. And at plus 3% as a share of total assets, you got to go back to, again, the late 1960s to see this ratio of cash on corporate balance sheets. So that's number 2. Number 3 is that we have record low mortgage debt service ratios. And so we're all sort of fixated on the 7% interest rate, a mortgage rate that's currently the marginal mortgage rate for anyone in the market to buy a new home. But the reality is most people are not in the market to buy new homes because the marginal mortgage rate is so high. The effective mortgage rate on all the mortgage debt outstanding is only 3.55%, which is why we're seeing effectively a record low mortgage debt service ratio in terms of the amount of income that consumers allocate towards servicing their mortgage debt on an amortization basis. And so at 4% there, it's very clearly we are not quite at levels that have historically been consistent with, triggering a real significant downturn in the housing market, let alone as a recession in the broader U.S. economy. Number four, the reason why the economy has been resilient, and as a function, inflation's been fairly resilient as well, is that we've have limited exposure to the volatile manufacturing sector. And so the blue line in this chart shows manufacturing shares of total non-farm payrolls, that's at 14%. The red line shows manufacturing share of nominal GDP at 18%. And the reason that this is important is specifically because when you talk about declining non-farm payrolls in and around a recession, if you look at the share of the net job loss that we've experienced in recessions in the U.S. economy, the share of that net job loss that's attributed to the manufacturing sector is 98% on a median basis across the 12 recessions that we've experienced in the U.S. economy in the post-war era. And so that's one of the reasons why, the red bars in our charts or the gray bars in other people's charts, keep getting spaced out as we move forward in time, is because the more cyclical aspect of the economy is just a smaller and smaller share of overall output and overall employment. And then lastly, as number five, one reason I think is really endemic to this particular business cycle alongside the cash is labor hoarding. What I'm showing in this top panel is the total labor force at about 161 million people. And we're about 5 to 6 million bodies short of the pre-COVID trend line. Whereas if you look at the gross domestic income, we are north of the pre-COVID trend line, which means we have recovered beyond trend in terms of income, the amount of potential demand we might have in the economy from corporates to hire, but we're well below trend from the perspective of folks available to hire. And at the margins, that's contributed to a decent amount of resiliency in the labor market. And so in terms of what does this all mean for market participants, one thing we've been sort of, we've been cautioning investors to understand that, hey, look, this market's probably going to be quite resilient and quite strong in 2023 before ultimately giving way to what we call the phase 2 credit cycle downturn. That's the part of the movie where the market's at the price in the credit cycle. And in our view that, we're at least 6 months away from that potential outcome. And so the reason we say, hey, you don't want to be a bear shorting the market into that is because history shows that markets are very strong leading up to a recession. If you look at the performance of the S&P 500 1 year prior to the peak, a year leading into the peak that it peaks at in and around a recession, what we find is that on a median basis, the return is plus 16% with an interquartile range of 14 to 20%, plus 14 to plus 20%. Even as bullish as that sounds, what I think is just as bullish is the fact that there are no non-double digit numbers in the sample, which means the market is always very strong in the year leading up to the start of a recession downturn. And so that's something that ultimately investors need to be aware. They also need to be aware that the recession process, the phase 2 credit cycle process, is still ahead of us. We're not at the bottom of the economic or market cycle yet. And ultimately, what you tend to see in a phase 2 credit cycle downturn after all this positivity that we've experienced historically in the equity market, which we're obviously experiencing year to date, is the markets tend to draw down pretty significantly in this phase 2 credit cycle process. So the median return is minus 24% for the S&P, and the interquartile range is minus 19 to minus 39%. So that's a long-winded way of saying markets are going to squeeze bears probably in 2 and 3 years maybe. But once we get to that process and we start to see the whites of the eyes on a recession, which is when we're most likely to see that, then ultimately that's probably when markets are going to give way and kind of make the bears eventually right in our view. So that's kind of
that timing was fourth quarter or first quarter. Is that right?
Yeah. So let me give you a little background on kind of why we see that as the highest probability outcome. And so there's 2 models that we use that are kind of that have the highest consistency in terms of predicting our timing of recession. One is the 3-month 10-year Treasury yield curve. I highly recommend everyone in the room stop looking at the 10-year 2-year 10-year yield curve. It's not that it's not predictive. It's just far less predictive than the 3-month 10-year. So if you're going to look at a yield curve, you might as well look at the right one. When we look at historical sequences of yield curve inversions, relative to the timing of recession, what we try to identify are the intervals that have the highest percentage chance of seeing a contraction in real GDP. That's the set of columns, and the highest percentage chance of seeing a rise in the unemployment rate. And when you look at the fact that we inverted in a 10-year 3-month in late October of last year, history shows that the interval that has the highest chance of seeing a contraction in GDP and a rise in the unemployment rate from inversion is the 13 to 18 month forward window. And so if you go 13 to 18 months forward from October of 22, that kind of puts you in November of 2023 to April of 2024. So that's kind of that's how we're having this view from the perspective of the yield curve inversion. So that said, sometime between Q4 and Q1 of next year, you should expect a recession to commence, not to be all over the tape, but to commence. You'll start to see, jobless claims rise in a much more significant fashion. We'll start to see NFP, trend towards zero and below zero in that process. If you look at another indicator that we look at in terms of timing the business cycle here in the U.S., because there's obviously different business cycles around the world, and we run all these models for all the major economies as well. And we look at the spread between consumer confidence, the present situation index, and the expectations index. And what we currently see is that we're at a minus 77, one of the deepest inversions in that spread that we've seen historically. And much like the yield curve, this thing has a perfect back test in terms of predicting a recession. But it doesn't mean just because it's inverted that a recession is going to show up next week or next month. And so what we're trying to do again is identify the interval from the trough of that inversion to the that has the highest probability of seeing GDP contract and seeing unemployment rise in the unemployment rate. And that interval is a 7 to 12 month forward interval with a 38% positive percent negative ratio for GDP and the 88% positive ratio for the unemployment rate. And so if you go from 7 to 12 months forward from the trough of this inversion, which occurred in February of this year, that still puts you in September 2023 through February of 2024. So this is why we're sort of getting this kind of Q4 to Q1 timeframe. We have a bunch of other models, but these are the ones that have the highest batting average in terms of being consistent and calling for a recession when the signal occurs. All right, cool. So in terms of one other thing I'd call out, so on the other side of this sort of resilient U.S. economy view, or at least resilient until we get into the window where you're likely to observe a recession. The other side of that coin, because that's obviously bullish, but the other side of the coin that's not so bullish is obviously inflation is likely to remain resilient as well as a function of that process. And so what we show in this chart here is the median trailing 10-year delta adjusted Z-score of a group of basket of indicators that represent each of these cycles. And so there's about 5 to 10 indicators, you know them all, with respect to that sort of help us identify where we are in these cycles relative to the start of a recession, or which is the 0th month on this chart here. And so what we know from studying all the previous business cycles that we have data for in this post-war era, there's been 12 business cycles that we have current data for, and we're currently in the 13th. The housing indicators on balance tend to break down below trend at about 18 months prior to recession. The orders indicators tend to break down below trend at about kind of 8 months prior to recession. The production and profits indicators tend to break down around kind of 4 to 6 months before recession. The employment tends to break down right on cue with the start of recession. I mean, quite frankly, that's how the NBER after the fact dates the business cycle. So that obviously makes a ton of sense. And then lastly, one thing we call out is the key takeaway from the slide, at least with respect to inflation, is that inflation tends to break down below trend 6 to 8 months after the recession begins. And so it's very, going back to what we discussed with Marty about the significant disinflation that we're seeing in inflation. I think we believe that's the sort of last bit of transitory disinflation kind of leaving the system. Maybe have one more month there, but once we get into the back half of the year, it's very likely that inflation really starts to level off, and we have to kind of wait to get into the sort of a recessionary process to see that play out. And just one quick thing before we move on from this is what those current indicators look like today. So the housing broke down quite a few months ago, around almost 2 years ago, below trend. The orders component broke down below trend right around a year ago, but kind of had a secondary bounce, and now has recently broken down below trend over the past few months. Same thing with orders, and we still have employment and inflation hanging out above trend, and ultimately are likely to follow the rest of the indicators lower in the coming months. One thing we'd also call out with respect to inflation is that you tend not to see very positive disinflation outcomes prior to a recession. And so what this table shows is a bunch of different indicators. By the way, you guys all have access to this deck. I gave Marty the link to this deck. So if you guys want to download that and review it, I'm happy to send the actual webcast associated with the deck as well. So Marty, if you want, I'm happy to send that to you as well.
We'll make it available to everybody. Yep.
For sure. And so what this table shows is a series of indicators like GDP, the credit gap, the labor market, the equity market, inflation, and the Fed funds rate in and around recession. And so as you guys can pretty much tell, is that we're very quantitative in terms of trying to help investors understand the full range, the full distribution of probable outcomes in and around critical market opportunities. And so with respect to inflation, as I mentioned, you tend not to see very positive disinflation outcomes prior to a recession. What this column shows the basis point change in the year-over-year core PCE in the year leading up to recession T-1. And what we find is that on a median basis, core PCE year-over-year is essentially flat leading into the recession at +5 basis points. Just as important as that is that there's only one negative outcome, and that was the year leading up to the 81-82 recession. All the other outcomes are flat or positive. And so what we know is that, hey, look, if we've seen a decent amount of disinflation already, and maybe that was the transitory nature of inflation kind of coming out of the system. Don't forget, we had significant supply chain disruptions, both domestically and globally. Those things have really come back in line. If you look at supplier delivery time, PMIs and ISMs, if you look at various metrics of, freight shipping rates, et cetera, from around the world, they're back to, sort of their pre-COVID means. And so on a lag to those kind of more real-time indicators declining, it's very likely that, we're getting back to their means. It's very likely that we're kind of long in the tooth or late in the process of the actual reported inflation data, kind of losing all that transitory inflation. But ultimately, we think inflation will kind of level off at a more sticky level that ultimately forces the Fed's hand on not delivering what the market is currently pricing in, which is obviously rate cuts, starting as soon as Q4 of this year. And so,
but by sticky, you mean how much?
Sorry, sticky in terms
you
of
said
inflation.
A sticky level of inflation?
Yeah. So right now, what we've
so
seen,
that's over 2%, I assume, right?
Yeah, for sure. It could be well north of 3. Again, so one reason we say it could be well north of 3, if you look at core PC inflation, which is obviously the Fed's preferred inflation metric, I mean, really since kind of late 2021, the mean and compound 3-month annualized growth rate of the series is around 4%. And if you just isolate the last 4 or 5 months, it's somewhere around 4%. And so we're not really making much progress in terms of the Fed's preferred inflation metric. We're making a lot of progress in things like trim mean CPI and median CPI, because there's a lot of just stuff in the basket that was really impacted by transitory inflation. But a lot of in terms of how the basket's weighted, it's a more thoughtful basket, core PC inflation, or even super core PC inflation, which is compounding at around 4.4% 3-month annualized. This number, we saw a significant move lower in super core CPI, but again, these time series are not constructed the same way. And so ultimately what we're saying is we might get one more month in June of disinflation, but it's very likely that month kind of leaves us somewhere between 3.5% to 4% in terms of all these key core inflation measures. And that's a problem in the context of the Fed's reaction function. And the reason that's a problem is because the Fed, for a couple of reasons, it's a problem. One, obviously, it's not 2, and they continue to harp on 2 being the primary driver. And I'll explain in a minute why 2 is so important. But more importantly, as it relates to the Fed's reaction function to the eventual recession, which again we see as starting in Q4, starting in Q1, they're forecasting the unemployment rate to rise by more than 50 basis points. And I'm sure most of you are familiar with the Psalm rule that shows the unemployment rate never rises by 50 basis points unless you're in a recession. And so the Fed is calling for the unemployment rate to rise in the most recent summary of economic projections from 3.7% to 4.5% by year end of 2024. And so they're sort of essentially arguing that there's probably going to be some mild recession between now and the end of next year. And so unless the recession that we are experiencing proves to be more than mild, i.e. moderate or severe, then it's very unlikely that the reaction function is going to pivot in a manner that is supportive of asset markets, at least not until we're getting well into that process. So that's one of these complicating factors that might make that phase 2 credit cycle downturn process more onerous than the kind of median decline of minus 24%, because we're probably not going to be getting the kind of liquidity provision from the central bank that we've been accustomed to as investors in the most recent kind of 12 to 14 years.
Darius, you've got about 8 minutes left. Can you, I don't know if you go into Europe at all on this, but can you opine on Europe as well? I think Europe is in a recession.
Yeah, Europe is very much in a recession. So if you think about one thing that I think specifically with respect to Europe, so we run all those same processes like the weather model, et cetera, for Europe. Actually, we do have some slides on Europe specifically. And what we're trying to do in this kind of back end of the presentation is help investors understand what really drives the liquidity cycle in various geographies like Europe, like the Eurozone. So in this chart here, this on the left chart, we show the trailing 10-year correlation to the year-over-year change in what we call our Eurozone liquidity proxy. As I mentioned, our liquidity proxy is the sum of the central bank balance sheet, broad money supply, and FX reserves ex gold. That's sort of all the kind of unencumbered cash that can be sloshing around the financial system in support or in retreat from certain assets. And so the blue bars represent the stock market. Red bars are the real 10-year yield on a year-over-year basis point delta. The green bars are the real effective exchange rate for the euro. Pink bars, the Eurozone OECD composite leading indicator. Core CPI is the light blue bars, and purple bars is the change in the unemployment rate. And what we try to identify, okay, what drives the Eurozone liquidity cycle over the medium term? Well, we know that if we analyze these correlations on a 3 and 6 month lead basis, the inflation tends to be the dominant factor in what changes, what explains the variance in the Eurozone liquidity cycle. And because we understand that inflation is the dominant factor, we look at all those same measures on a cyclical and structural z-score basis, so trailing 3 years and trailing 10 years, to identify, okay, is there a setup that implies an inflection or adverse or positive liquidity cycle developments in Europe, irrespective of the recession. And what we see is that inflation, being the dominant driver on a 3 to 6 month forward basis, is still moving in the wrong direction on a levels basis in terms of the disease scores on a 3 year and 10 year basis. So that's kind of a long-winded way of saying Europe's in a recession, and not only are they in recession, it's very likely that the ECB continues to tighten over the very medium term. There's a few factors that are compounding that. So Madame Lagarde at Thursday's ECB press conference really took a step forward in her response to inflation and actually kind of giving the market freedom to price in kind of a terminal policy rate of 4. Prior to that, the market was kind of on the fence on that, and her guidance was very hawkish and sort of allowed the market to climb up to 4 in terms of the policy rate expectations. Secondarily, they announced that they were going to, or not announced, they reaffirmed that they were going to allow for the total amount of the pandemic financing to roll off their balance sheets. About 477 billion euros are rolling off the balance sheet at the end of next month. And then also the ECB is identified or sort of authorized no more principal reinvestments in their asset purchase program. That's about $3.2 trillion. And so you put those 3 factors together: the policy rate, the roll off of the pandemic financing, the no more reinvesting in the asset purchase program, and on top of the kind of leading indicator that says they shouldn't be supplying liquidity anyway. We're effectively going to have a situation in Europe where the growth cycle actually gets worse without any sort of counter-cyclical response from the monetary authority. And that's kind of a real negative setup. So I know a lot of investors have been kind of playing luxury goods, et cetera, in the hedge fund space in Europe. That may continue to work. We certainly see the Chinese cycle improving with the advent of recent easing measures, but it may be something that ultimately is there's just probably too many people in the trade in the context of really negative liquidity conditions. And so one final thing I will say on Europe, particularly with respect to the US, is that when you look at terminal and floor rates in these respective regions, we're at terminal rate of 5.38% as derived by the OIS curve here in the US. The floor rate, if you look at the min value on the OIS curve out to 2 years, it's 3.26%. So money markets are pricing in 212 basis points of cuts in the US. It's probably not at the center of the distribution. It's probably a bimodal distribution, but the outcome of that bimodal distribution is minus 212 basis points. In Europe, they're saying the terminal rate policy rate, ECB deposit rate is 4%, whereas the policy rate floor is 2.87% with 112 basis points of cuts. So this is a really interesting setup and a very asymmetric setup in the currency market right now, because the money market's effectively calling for a more reactionary, more dovish Fed relative to the ECB, even though the ECB or the Eurozone economy is already in recession, and it's a recession that's likely to get worse because of the likelihood that these adverse liquidity cycle developments kind of compound the matters. And so in our view, this sort of sets the dollar up for, maybe we see a grind higher in the dollar, particularly as we get into the latter part of the summer and we get past the kind of peak disinflation we're going to see in the US. One date I'll throw on your calendars is August 10th. We get July CPI here in the US, and the June CPI should be quite dovish, particularly on a year-over-year basis, If you recall, the base effect on a month-over-month basis last June was 1.2% for headline and 0.6% for core. Those numbers drop off to 0% and 30 basis points respectively. So we could see we might see inflation start to reaccelerate again in the month of July.
Yeah, I guess one of the questions I was asking about Europe was that, Germany has historically been the engine of Europe's economy, and it's kind of a sick man right now because of this war and the change in energy policy, right? So it's and I guess we have another speaker who's going to be speaking next week who's going to say sell Europe, right? That's his perspective. So it's just very interesting times. But I mean, the energy story in Europe is not good, and the labor story in Europe is not good right now, especially in Germany, where people are just aging out of the workforce so dramatically. So Darius, I've got like 2 minutes here, but so you have a subscription service, and you sell research, and you sell alerts, et cetera, et cetera.
Yes. So that's sort of our we have two businesses. One, we have just a broad subscription service that anyone can sign up for. Obviously, our primary target audience is obviously institutional investors, and then we have what we call our Protopur service, with it's your traditional kind of Wall Street white glove consulting service. So we do bespoke work on behalf of our clients there. So we got about, I think we're up to around 50 of those clients after 2.5 years, and probably have a little capacity, maybe take on 50 more.
So you do a lot of special projects as well. And your clients are primarily like hedge funds, private equity firms?
Yeah, so it's primarily large asset managers, corporations, like their CFO suite or their treasury departments. We consult with a handful of central banks as well. And then we obviously have a lot of investment advisory and high net worth individual clients as well. So in terms of professional investor versus retail investor, it's probably 2/3 professional investor, with about 1/3 of that being your sort of traditional large asset managers. And then the kind of final third of our overall client basis is probably high net worth retail folks who can have the time, capacity, and money to actually weaponize all this information.
So like large RIAs as well. So
yeah, exactly.
Like large banks, et cetera. So
exactly.
Wow, that's really fun. I love the data. I'm a data slut, and
I've never heard that one yet.
Yeah, I love it. I'll look at data day and night, right? So it's really great. And by the way, I love the term macro tourist. I think you get extra points just for saying that. Any questions from the audience here?
Oh,
Any
awesome.
thoughts on the economy or the general outlook, or what one point that we didn't really address was reshoring and things along those lines, which is obviously there's this change in world economics where the United States is trying to pull more manufacturing back to friendly shores, et cetera. So I do have a question from the audience. Yeah.
Yeah, I had a couple of things. One is the unemployment rate, I feel, is a bit misleading because it doesn't count people who have given up looking.
Right.
About these kids in their parents' basement, things like that. I'm concerned that that's a statistic that's not being...
Basement adults? Yeah.
That's one thing.
People living in Oregon state parks?
Right. And then there's also people that are employed under the radar. They're working only for cash, but I see them all the time.
The non-visible economy.
At the Home Depot, there's like 20 people there standing around looking for a job for the day.
Like to carry items.
My face doesn't match with the numbers, and I get why that's being done. But anyway, I'd be curious if somebody has to do a deep dive eventually to figure out what the real unemployment rate is.
Right. Yeah. I mean, there's data, and then there's government digested massage data, right? So.
And as well, the CPI also I don't trust because it's the benchmark for Social Security increase. So it's artificially, I think, manipulated as well to include certain bucket items or basket items that don't represent.
CPI is manipulated to be lower than it really is to keep cost of living increases in Social Security and other pension items from escalating. And any thoughts on all that, Darius? So basically the question is, the political aspect of the data.
Yeah, absolutely. So I'll start by saying, so I'll address that in both in order. With respect to the unemployment rate, recall that we're seeing a significant degree of labor hoarding relative to the size of the labor force, and we would argue we would actually push back on the view that the unemployment rate is manipulated in a way that's favorable for the business cycle. Right now, we would actually argue that the unemployment rate is actually artificially higher than it should be as a function of the decline in the labor force. You could see your unemployment rate is probably somewhere closer to 2.9% if you added all these folks back to the labor force. One thing that sort of gives us confidence that the labor market is not being meaningfully mismeasured. It's always being mismeasured, but meaningfully mismeasured is what we care about as investors. We see, we divide employment into the establishment survey relative to the household survey, and we do see non-farm payrolls in the establishment survey are growing much faster than the household survey, 2.2% 3-month annualized versus plus 1% 3-month annualized. But the one thing I'll say is we have yet to experience a negative number in terms of the household survey. We're still growing and compounding, albeit obviously at a below trend pace. So that gives us confidence that the labor market, for as much bear porn you can read on Zero Hedge, is still kind of hanging in there, and we can obviously confirm that with jobless claims. The second thing I would call out is in terms of whether or not inflation is artificially being depressed by CPI. One thing we call out is that, okay, there's a lot of different measures of inflation that we can look at from the perspective of the different agencies that produce inflation. Obviously, you get the BEA in terms of the PCE data points, and the BLS in terms of the CPI data points, which feed directly into the cost of living adjustments. By the way, we had a plus 8% cost of living adjustment in January. So if they're going to massage the numbers, they're not doing a very good job of that. But one thing we call out is that anytime you're talking about macro, and I'm sure this is very similar to company fundamentals. I was actually a retail analyst for about 6 months earlier in my career and didn't enjoy it and switched over to the dark side. But one thing I noticed even as a retail analyst is it's not whether something is good or bad or too high or too low. It's the rate of change of the process. It's going from great to good or from bad to less bad is what actually matters to asset markets. And so in the context of our systematic process in terms of how we use to communicate all this information into actionable investment strategy and trade ideas for our clients is understanding this through the lens of our grid asset market backtest. We backtested that, that 4-quadrant regime chart here, Goldilocks, reflation, inflation, and deflation, through the context of annualized expected returns, percent positive ratio, volatility, covariance, and expected Sharpe ratios, and with the understanding that it's not about the level of growth in inflation, it's about whether growth and inflation are trending higher or trending lower. That provides most information for the asset market. So that's a helpful kind of thing to leave everyone with, which is, it's not about getting to the quote unquote right number. Macro is more about how is the number changing relative to the previous condition, and how is it changing relative to what's priced in or positioned for in asset markets. And I think that's something we specialize in at 42 Macro.
So it's more first and second derivative sort of stuff, right? Exactly, right.
Second and third.
Right. I have an there was an allocator I had from Princeton University. He was actually a real rocket scientist. He had aerospace engineer from Princeton. And he used to say all they cared about was second derivative stuff when it came to hiring managers. He's like, what's the momentum or direction of where they're going? He used to allocate like $50 billion a year or something like that. So, but anyway,